Hey, it's Jeff Green of Green Financial Group. Thanks for tuning in the video blog today. Today, we're going to talk a little bit about Russia, the markets, and inflation. Stick around, be right back. Okay, so it's February 15th, 2022. So I say that to emphasize that really because you may not see this video until a couple of weeks after it goes through production and compliance and all that. And by then, what I say with regards to certain things may already be outdated. So here we are on February 15, 2022, and you see a lot of gyrations in the market. Today, the market is higher on news that Russia is sending 10,000 troops back to the barracks, thereby de-escalating the situation in Ukraine. I'm all for that de-escalation. I think that that's a bad situation going on over there. However, I will also say it seems hard for me to believe anyway that Putin can back down from this. He's done this major buildup of troops, and if he backs down, and I hope he does, it will make it very hard for him to bluff again in the future. And that's what they do a lot of. So we'll see what happens in there. I hope it de-escalates, but you're seeing a lot of market gyrations right now, back and forth on the daily news of a geopolitical event that we cannot control. So there's that to contend with. We've also got, of course, inflation. And I get a lot of questions about inflation. So let me start by saying inflation at 7.5%. Surely is higher than what any of us are used to. We have not seen inflation of this magnitude for 40 years. And, you know, we've been running around 2 to 2.5%, pretty steady, a little higher, a little lower at different times. And now that's 7.5% is a big jump. So it's hard to, kind of realize really what's going on in the market sometimes when it's been so long that we've seen any of this. But let me tell you, I don't believe that it's going to be runaway inflation, hyperinflation, or anything like that. The Fed used to say this was transitory due to supply chain. That's not the case. Supply chain has this much to do with it. The real problem is, and I'm going to get geeky with you for just a minute on economics, but if you remember from Economics 101, there's this thing called M2. M2 is the money supply. It's demand deposits is what we have in the bank, spendable dollars. For the past decade or so, it has been growing at a steady rate of about 6%. Nice, even rate. Well, since the pandemic, the M2 money supply has gone up 40%. That is a huge amount. That is a huge amount of dollars coming directly into consumers' hands. So inflation is here to stay for a while. The good news is that long-term investors believe that the Fed can wrestle inflation with relative ease. And here's why I say that. Because the Fed calculates what the average inflation rate will be, the 5-year average inflation rate will be 5 years from now. It's called the Fed forward inflation. So what they're saying is, and this is, according to the Fed, according to long-term Treasury investors, because that's really kind of, the bond market kind of predicts where things will go if you look at it in certain ways. So what it's saying is that in 5 years, the 5-year average after a 5-year period will be around 2.5%. So they're saying inflation will come down, that the Fed can handle this, again, with relative ease. So I would buy into that. In our opinion, we believe that to be true as well. But rates are going to go higher. Now, there's a big difference between a tight Fed and a less loose Fed. And they're going to be just less loose. If the Fed raises 125 basis points in 2022, it still will not be a tight Fed. It'll just be less loose. And in our opinion, they need to do that. It's time to do that. They've had rates too low for too long. And so we also expect, in our opinion, that longer term rates will not have an equal reaction as to the rise in shorter term rates. Now, they will go up for sure, and that will be a headwind for equities, but earnings, in our opinion, should more than offset that for 2022. So we don't believe that you're going to see, major. Certainly there'll be headwinds for equities, but we can still, in our opinion, have a pretty good year in equities. You're seeing the market kind of shift right now, all this volatility, Russia, inflation, rate hikes, there's all these different things where kind of a changing of the guard going on in the markets, right? So you're seeing the FANG stocks, Facebook, Apple, Amazon, Netflix, Google. These are what we call the FANG stocks, or the big techs. You're seeing them, we saw that in Facebook's earnings just recently. So you're seeing them, kind of come back down. I think you're going to see, in our opinion, again, the earnings growth of those companies kind of slow. Still going to make money, still have growth of earnings, but the growth that we've seen over the past few years is going to slow a little bit. Give room for other stocks to do better, maybe perhaps some of the value stocks, perhaps some of the financial stocks, et cetera, rising rates. The banks get to have more spreads along the way. So thanks for tuning in the video blog today. Remember, any concerns or questions, comments, feel free to reach out to us, email, call. We look forward to hearing from you. Remember, stay the course.